One company. Just one. And it controls a staggering 73% of the entire global chip manufacturing market.
Think about that. Nvidia. They don't actually build their own chips. Apple? Nope, doesn't build them either. Same goes for AMD. They're all completely 100% dependent on this one single company over in Taiwan.
And in just a few days, that exact company is reporting earnings that could literally move the entire AI trade. We're talking ripple effects across the whole global economy. So today, we're breaking down exactly what to expect from TSMC's upcoming report. We'll look at what these massive numbers actually mean for your portfolio and, investigate why this supposedly unshakable stock just went through one of its roughest weeks of the entire year right before their most critical earnings call. Let's dive in.
Now, just a really quick note before we get started. TSMC hasn't actually reported its second quarter results yet as of recording this explainer. So everything financial we're looking at today reflects the most recently confirmed data, plus Wall Street's expectations heading into the report. I'll make sure to be super clear about what's confirmed history versus what's just a forecast. By the way, if explainers like this help you get prepped before a big report drops, definitely hit subscribe, drop a like if you want more of these timely previews instead of just recaps after the fact, and let us know in the comments which company's earnings you want us to break down next.
All right, Part 1, Upcoming Earnings Expectations. The Q2 2026 Estimates.
So let's start with the date you need to know. Taiwan Semiconductor Manufacturing, ticker TSM, reports its second quarter 2026 results on Thursday, July 16th. The call kicks off at 2 a.m. Eastern Time, since obviously it's held in Taipei. Now, looking at Wall Street's estimates, they're expecting revenue of roughly $40 billion. That is up from $30 billion in the same quarter last year. Just pause and think about that for a second. A 33% jump for a company of this sheer massive scale? That's almost unheard of. It's literally like adding an entire Fortune 500 company's revenue to their top line in just 12 months. And earnings for ADR unit, they're expected to come in around $3.80, up from $2.47 a year ago. But here is a stat that should absolutely grab your attention. TSMC has beaten Wall Street's estimates for 4 consecutive quarters now. And they aren't just barely scraping by. They're posting an average positive surprise of over 8%. So this is a company with a genuinely proven, rock-solid recent track record of just smashing expectations, not just meeting them.
Moving on to Part 2, the Global AI Choke Point, TSMC's market dominance.
So, you might be wondering, why does this specific earnings report matter so much more than a typical quarter? Well, it's because TSMC sits right at the exact choke point of the entire artificial intelligence infrastructure boom. Literally, when companies complain about a shortage of AI chips, what they're effectively talking about is a shortage of TSMC's advanced manufacturing capacity. TSMC is the factory engine actually building the advanced chips designed by Nvidia, AMD, Apple, you name it. Because of that, this earnings report isn't just a scorecard for TSMC. It's a real-time global signal telling us whether the whole AI spending boom is still accelerating or if it's finally starting to hit a wall.
Okay, Part 3, the baseline. Confirmed Q1 results and advanced nodes.
Before we talk about what might happen next, let's quickly ground ourselves in their most recent confirmed numbers from Q1, since, these are actual reported results. Revenue hit a record $35.9 billion. That was up 41% year over year, with net income jumping an unbelievable 58%. Management also guided for full year 2026 revenue growth above 30%, driven mainly by the shift to agentic AI, which basically requires way more computing power per task than those early chatbots. Now, look at how this breaks down. Advanced nodes, which means the absolute cutting-edge ultra-small manufacturing processes below 7 nanometers, make up 77% of total wafer revenue. And let's really zero in on that 28% slice, the 3 nanometer tech. To put this into perspective, the transistors on these chips are literally measured in atoms. It's the absolute bleeding edge of physics, and TSMC completely dominates this highly profitable space.
Which brings us to Part 4, key metrics to watch. Guidance, margins, and packaging.
All right, so here's exactly what you need to be watching for when the numbers drop on July 16th. Number 1, does TSMC raise its full year revenue guidance? Back in Q1, they guided for Q2 revenue between 39 and 40.2 billion, which is about 10% sequential growth. Well, at least one analyst covering the stock has suggested it's highly likely they'll raise both full-year guidance and their capital spending plans. If that happens, the market is going to see that as a massive, flashing green light for AI demand durability. The second thing to keep an eye on is their gross margin. Last time, they guided between 65.5 and 67.5%. It's a really delicate balancing act. They're weighing the crazy high profitability of their optimized factories back home against the massive margin-diluting costs of building new facilities overseas, especially that big expansion happening in Arizona.
And the third critical thing to watch, any updates on CoWoS. That stands for Chip-on-Wafer-on-Substrate, which is TSMC's advanced packaging tech. This has literally become one of the biggest bottlenecks in the whole AI supply chain. Think of it like this. The most advanced AI chip is like a supercar engine, but the CoWoS packaging is the transmission that actually gets that massive power to the wheels. Without that packaging to connect the chip properly to its memory, the engine just revs in place. It's useless. So finding out how fast TSMC can expand this specific packaging capacity is absolutely essential for anyone tracking the AI sector.
Let's move to part 5, the massive CapEx program, financing the AI boom. We really need to talk about capital spending because the sheer scale of the numbers we're dealing with here is genuinely enormous. TSMC has guided for capital expenditures somewhere between $52 and $56 billion for all of 2026. And honestly, multiple analysts think they're going to raise that number even higher when they report. Let me put that into perspective for you. $56 billion? That is roughly the gross domestic product of several small nations. And TSMC is spending all of that in a single year just on factories and equipment. That is quite literally what it costs to build the capacity the AI industry needs just to keep up with the current demand, let alone whatever future long-term growth is coming.
Next up, Part 6, Understanding the Risks, Sector Pullbacks, and Global Threats. Now we have to talk about why this stock has actually had kind of a rough stretch lately. This is exactly the kind of critical context most explainers completely gloss over. TSMC shares actually fell more than 9% in the week leading up to this earnings report, pulling back from a 52-week high of around $479. But, you've got to look at the rest of the board. This wasn't really a TSMC-specific problem. It was part of a much broader semiconductor sector pullback. Look at the data. The Philadelphia Semi Index dropped over 10%, and the VanEck Semi ETF fell about 13% over that same stretch. But on top of that broader weakness, there was a uniquely localized event. A really powerful typhoon actually forced Taiwan's financial markets to shut down in early July. That delayed TSMC's routine June monthly sales report. Normally, investors use that report as their last clean read on the quarter before the official earnings call. But because of the weather delay, everyone only had about 72 hours to digest those sales numbers before this massive full report. So yeah, that definitely added an extra layer of anxiety and uncertainty right before the bell. So let's be totally honest about the core risks here, because a company this indispensable to the global economy still carries some very real dangers. The biggest one, by far, is geopolitical risk. TSMC's most critical manufacturing operations are still heavily concentrated in Taiwan. Escalating tensions between the US and China, plus deteriorating cross-strait relations, that's an ongoing existential risk that you just don't see with almost any other major stock. Moving down the list, the second risk is margin pressure from that massive capital spending program we just talked about. Building these new overseas facilities in places like Arizona costs way more per chip than doing it at their highly optimized home base. Some analysts have warned that continued heavy spending could seriously compress their margins if AI demand ever cools down. And finally, valuation. After rallying roughly 90% over the past year, TSMC trades at a forward PE ratio in the high 20s. One recent model specifically warned that if AI capital spending slows down in late 2026, that multiple could compress back down toward the low 20s, and that would pull the stock down significantly, even without anything going fundamentally wrong at the company itself. Which brings us to Part 7, Wall Street Consensus, Setting the Expectations.
So where is Wall Street actually at heading into this report? Right now, the consensus rating across the board is sitting firmly at a strong buy. But as you can see, the specific price targets vary pretty widely depending on who you ask. They range from a more cautious bear case estimate around $400 all the way up to a super bullish $625. Interestingly, we've seen several major firms like Bank of America and Susquehanna bump their targets up to the 575 to 590 range just in the past week alone ahead of the report. When multiple big financial institutions raise their targets in the exact same short window right before an earnings call, that clearly tells you institutional expectations are leaning heavily bullish going into Thursday.
So what's the bottom line for you as an investor watching this all unfold? Look, TSMC's fundamentals are about as strong as any company in the entire market. They are at the undisputed center of the AI supply chain with a level of market dominance that's genuinely hard to find anywhere else on the planet. But, and this is a really big consideration, the stock has already made an enormous move over the past year, it just weathered a sharp pullback tied to broader sector nervousness, and it still carries that unique geopolitical risk. If you already own it, Thursday's report is worth watching incredibly closely for a full-year guidance raise and any commentary on AI demand durability. If you're thinking about buying in before the report, just remember, you're betting on continued stellar results from a company that has crushed expectations 4 quarters running. Because expectations are already set so incredibly high right now, a merely good quarter could actually disappoint a market that's gotten totally spoiled by consistent massive beats. As always, guys, please remember this explainer is strictly for educational purposes and is not financial advice. Investing inherently involves risk, including the potential loss of principal, so always do your own research or chat with a licensed financial advisor before making any investment decisions. If this preview helped you get ready for TSMC's earnings, hit that subscribe button so you don't miss our follow-up breakdown once the actual results drop. Drop a like if you found these timely previews useful to you. And before we go, I want to leave you with a thought. If TSMC is truly the indispensable single point of failure for the entire global AI revolution, what actually happens to the global market if that engine ever sputters? Let us know what you think in the comments below and tell us which stock's earnings you want us to preview next. Thanks so much for watching, and we'll catch you in the next one.